Hey, what's going on guys? Welcome back to this week's episode. I'm Filip Brnadic from Project 10X, and today I want to discuss what Bitcoin adoption in 2021 and beyond will look like. To do that, we're going to go over Hyperbitcoinisation, how it would occur, what is the inevitability of it occurring, and what this all means for you as an investor and member of society. So, what is Hyperbitcoinisation? Essentially, it is the rapid adoption of the Bitcoin monetary network. This leads to it becoming not just a reserve asset that dollars are pegged to, but the global monetary supply itself. So, in other words, Hyperbitcoinisation can be thought of as Bitcoin going all the way. From adoption by retail, private and public companies, as we're seeing today, to insurance companies, super funds, and in a few years' time, central banks and world governments. There are so many people right now that think this concept is impossible, but to Bitcoiners, it is inevitable, and for good reason, as I'll go through today. So, to understand how this is possible, I think it's important to get a grasp that throughout history, the hardest form of money has and always will win out in the end. So fiat currencies, or cash, are nothing more than a financial experiment compared to other historical stores of value. So it may be hard for many to conceptualize this because we've only lived during the existence of fiat. But if we take one step back and look at the bigger picture from a historical perspective, we discover that fiat has only existed for a tiny amount of time compared to other respective forms of money. So let's now establish what makes Bitcoin a superior form of money, particularly in comparison to gold and fiat currencies, which were these traditional stores of value. So importantly, Bitcoin is more divisible, verifiable, and transportable than gold. It is also the only form of money that can be audited at any time on the blockchain by anyone due to it being a protocol operating through the internet. So the next time you hear our dear friend, US Secretary of the Treasury, Janet Yellen, saying that cryptos have been used to launder drug money and finance terrorism, just ask yourself, what level of criminal do you have to be willing to put your illicit behavior on the blockchain for the rest of the world to see forever? Anyway, arguably, the most important aspect of Bitcoin, and one of the main reasons it is such a revolutionary financial technology, is that it has a programmatic monetary policy that is not controlled by humans. Not controlled. Human control has always caused the erosion of a currency's value throughout history. Just take a look at the destruction of the purchasing power of the US dollar. So this visual representation helps to clearly understand what money printing and devaluation of currency really means in everyday life. Although it speaks absolute volumes by itself, just take a moment to realize that the dollar has lost 95% of its purchasing power in just 100 years. And as this money printing progresses, this situation can only deteriorate. And it's a problem for us as individuals because it makes virtually impossible to save money. So it should start to become clear that all currency collapses have either been rooted in human control of monetary policy or a harder form of money coming along to replace it. However, Bitcoin is such a revolutionary invention, partially because it is the first currency to completely eliminate the possibility of humans manipulating A, monetary policy, or B, supply. So this is possible for two reasons. The first being that node operators running the Bitcoin monetary network are decentralized across the entire globe, from Russia to China to US and Australia, leaving no centralized point of control or attack. The second reason being that the protocol cannot be altered. New layers can be built on top of the protocol, but the base layer itself cannot be changed and never has been changed since Bitcoin was introduced in 2009. So the supply function that is written into the protocol will never be changed. This means that there is and only ever will be a maximum of 21 million bitcoins, and there's no way to alter that. This makes Bitcoin as superior to gold and all other money from a stock to flow standpoint. For example, as the value of gold rises, more miners step in with better technology and higher monetary incentives to create these innovative ways to find gold. However, that causes the gold price to dilute back down every time there's a major rally, as more supply is generated. So this is where that unchangeable supply function of Bitcoin differentiates itself from all of these other typical stores of wealth. When there's a major Bitcoin price rally, new miners step in to get a piece of the action, but no matter how much stronger their mining technology becomes, they cannot be rewarded with more coins per block. They mine as much as they can, and that mining is equivalent to 6.25 Bitcoin per block right now, and it's mined roughly every 10 minutes. So every 4 years, this block reward given to miners for confirming transactions on the network is cut in half. In 2009, the reward started off at 50 coins. In 2012, it became 25. In 2016, it became 12. And most recently, in 2020, it became 6.25 coins rewarded per block. So, with this being said, if miners want a bigger piece of the action, they each have to produce more hash rate. This production of hash rate creates a competitive acceleration of the hash rate, protecting the network, therefore making it more secure with each price rally. So not only does it make the network more secure in a sense, but this programmatic supply function makes Bitcoin exponentially more scarce over time as the flow rate, or the number of Bitcoin being mined, decreases. So this feature of the protocol is vital to Bitcoin's success, not only from a price standpoint, but because it creates this effect of programmatic entrenchment into the traditional financial system. So what I mean by that is, every 4 years after each respective halving, price rises even if demand stays the same, because the rate of new supply is cut in half, and that's just basic, supply and demand. So this causes the price of each coin to rise by default, right? This price rise then draws, new participants or hodlers such as you perhaps or myself into the network, in addition to more hash rate through miners, as I mentioned earlier. So during these exponential price rises, speculators or retail investors step in towards the end, eventually leading to a blow-off top. So many critics reference the fact that Bitcoin is volatile. But if you look at the history of money, or any network for that matter, whether it's Facebook or otherwise, it is adopted in exponential waves of new adopters. In that aspect, that volatility is actually a feature rather than a bug. Traditionally, there is a 75 or 80% decrease following each of these cycles, but after which there are more hodlers and miners left behind each time, right? Raising that price floor before the following 4-year cycle. So the idea that I'm talking about was first summarized by 𝗕𝗶𝘆𝗶𝘆𝗂 in his book, The Bitcoin Standard. But it was visualized by a Dutch quant investor who goes by Plan B. So he visualized that these 4-year cycles, by calculating price through scarcity, and was able to do so due to Bitcoin's programmatic absolute supply. So in the chart, you can see that the 4-year cycles discussed, you can see the blow-off tops overrunning the stock to flow price function, and most importantly, exponentially growing network effect, when viewed on a logarithmic chart, that is. This network effect is no different than that of Facebook, but we have never seen such a thing measured in dollar terms before. So 𝗕𝗏𝗁 does a fantastic piece on network effect in one of his latest Real Vision articles, and I'll link that in the description below. So as I mentioned before, these 4-year halving cycles are crucial because they cause programmatic entrenchment into the financial system. Plan B illustrated this using the term phases, I won't go into the math behind these models, but if you are interested, I'll put a link to his website in the description below. So, next thing I want to discuss is escape velocity. In theory, these network or price cycles will continue until Bitcoin reaches escape velocity or hyperbitcoinisation, which is where it finally breaks the stock to flow model to the upside. This would likely happen for two main reasons. The first would be that the US dollar hyperinflates, causing Bitcoin, which is becoming exponentially scarcer, to be measured in a unit that is becoming exponentially less scarce because of the old money printing. Otherwise, if enough people, such as you and I, discover the stock to flow model, it would also cause them to front run the stock to flow model, and this would have a self-enforcing effect on the price. And when you get into the multi-trillion-dollar market cap range of Bitcoin, which by the way, we're already at $1 trillion as of today, people will begin, or companies will begin, to do due diligence on Bitcoin, therefore realizing it is a superior form of money. So, the more likely outcome is a combination of both of these phenomena. So this exponential S-curve adoption is nothing that has not occurred before in society. It's just that many have never seen this effect take place through something with a monetary value attached to it. S-curve adoption can be visualized in this chart, and to put it into perspective, we are at the red dot of the S-curve. So we're at the early stage, very early stage that is. Now, there's no way to predict what Bitcoin will ultimately be priced in nominal dollar terms. That is, as Max Keiser put it, there is no telling how much more money will be printed leading into the future. In 2020 alone, the US Federal Reserve printed 30% of the entire US monetary supply. And the new $1.9 trillion stimulus bill that has passed actually, is larger than all of the money inserted into the financial system or the economy during 2020 combined. So why is it in the best interest for society as a whole to be measured under a scarce monetary supply? First, let us think about this from an investor's point of view. In a general sense, when trying to value a business, you are taking the track record of free cash flows and trying to predict these free cash flows at some point in the future. Or at least that's what you're trying to do when you're performing fundamental analysis of a stock or of a business. So you then compare what you predict those future cash flows will be to the current valuation, and then you come up with a decision whether the business is worth investing in based on its current valuation. However, there is one teeny tiny problem. This process assumes that your measuring stick you are using, which is dollars, is constant. So, as we all know, money printer go brrr. This is certainly not the case, therefore making the process of valuations or valuing companies based off of free cash flows very difficult. Having a constant in place, like the speed of light in physics, opens a whole new rational way of approaching this subject. By introducing a constant to the financial system, it would benefit investors hugely, immensely, enormously, due to the unchangeable aspect of the base layer protocol and therefore the supply of bitcoins. Bitcoin is that constant that is needed to fix this problem in the current financial system. So, if businesses are not generating free cash flows, they are unable to stack Bitcoin on their balance sheet. So, given the current zombie company bailouts taking place under the current system, this need to generate free cash flows would be a revolutionary move forward for capitalism and push towards a free market or a true free market. So a scarce monetary supply benefits not only investors but general members of society as well. For the first time in nearly 100 years, there is incentive to save again. Under the current system, we're incentivized to invest our money into assets such as property and equities that appreciate against the dollar. Most savings accounts today yield so much less than the increasing rate of inflation in real terms. I had a friend recently who sent me a photo of his bank offering a whopping 0.05% interest on cash. To put it into perspective, as of today you can earn 3 to 6% on Bitcoin. That is 60 to 120 times more than the bank is giving him. Not to talk about stable coins where you earn 345 times. So this idea that we no longer need to search for ways to deploy our cash just to beat inflation is a great step forward for many people that are simply just trying to preserve the value of their life's work, right? So Bitcoin was first adopted in countries such as Nigeria and Venezuela with hyperinflation occurring all around them, as it was a superior way for citizens of these countries to protect their wealth. Nigeria recently banned Bitcoin and they're trading at a 36% premium. However, these early adopters at the left side of the S-curve will benefit most from this monetary system. Large governments will be later adopters of the system, therefore making Bitcoin the greatest wealth transfer in history. So this brings up the concept of game theory. Many claim that Western governments, and especially the US government, will surely shut down Bitcoin because they are used to the government being able to bully anyone they want. But, as I mentioned earlier, the decentralization and sheer size of the Bitcoin monetary network is, in my humble opinion, now past the point of return, and it's near impossible to shut it down. Any raised capital gains tax on Bitcoin gains, it incentivizes people not to sell their coins and hodl them longer term, counterintuitively raising the price. Also, contrary to what people think, states are beginning to show early adoption to Bitcoin to draw in users of the monetary network and increase their states' respective economic output. Hello, Miami. Any adopters of the monetary network are likely to leave states or countries, such as India currently, with harsh Bitcoin regulations for places that champion Bitcoin adoption, such as Singapore, for example. So, in my opinion, the creator of Bitcoin, Satoshi Nakamoto, had an immaculate understanding of game theory. So I think we also need to understand that the United States is the only country that gains great benefit from itself being the reserve currency. For example, this allows them to have greater control of trade. It gives them the power to inflate away their own debt. But for other countries such as China and Russia, they will jump at the opportunity to take that reserve currency status away from the US. So this means that even if the US doesn't want to adopt Bitcoin, which is certainly not the case, they will have no choice but to eventually take a partial position on their balance sheet. And once that happens, Bitcoin moon. And the reason they're going to do this is to hedge against possibly losing power during a transition to a global Bitcoin monetary system. They want to stay on top, right? So any regulations against Bitcoin from the US government are just delaying the inevitable. And they would be better off taking steps to embrace this new technology in ways other countries have done. To summarize, hyperbitcoinization is not improbable, it's inevitable. So this monetary revolution ushers in an era of the self-sovereign individual. It ushers in government limitation and economic empowerment. So I think Bitcoin will lead to the greatest transfer of wealth in history. Just remember, in the event of rapid hyperbitcoinization with insurance companies, super funds, central banks and world governments adding it to their balance sheet, which I personally believe we are in the rumblings of today, zero is not the right allocation for this asset. So that's all we have time for today, folks. If you enjoyed today's video, make sure you hit the like button and subscribe if you want to stay up to date with our latest videos. Peace!